Hi everyone, my name is Yehuda. I'm a content contributor to YedaCenter. What is a perpetual license? A perpetual software license is a license that once you purchase it, you have the right to use it indefinitely. After an initial period, which is typically 1 year, the vendor will offer you a support package that include continuous software updates and basic technical support at an annual cost which is typically in the range of 15 to 25% of the original cost of the software. Why consider something else? I mean, this has been working for many years, so let's now discuss the subscription model. And the subscription license model grants you the license for a limited period of time. This period is the period for which you paid for, meaning you should consider this subscription license model as a type of service. You pay for the license for a certain period, you are granted the right to use it for that period, just like any service, whether it's a cell phone, cable TV, and so on. Since it's a type of service, it's referred to as SaaS, software as a service, and again, just like with any type of service, it's given for a limited period of time for which you paid for, and then you need to renew your license to further enjoy it. So what is better? Well, in order to determine that, we need to review several variables and how each affects both vendors and customers. I can already share with you that there is not a single answer. Based on the valuation of those parameters, each one will decide what is better for him. So let's start with cash flow. Payment for a perpetual license will be typically made in full after delivery of the software or at the end of the installation. In case of a subscription license, payment will usually be made every month or every year in advance. So if we take as an example of a software that has a perpetual, it is sold for $100,000. Once I install it during the year, then I'm entitled to receive $100,000. In a subscription model, and I'm not going to discuss the relationship, the price relationship between perpetual and subscription. We have a different podcast on that. So for the time being, let's just assume that a perpetual license worth of $100,000, in a subscription price, it will be, let's say, $35,000 per year. So if I am purchasing at any point in time a subscription license for 1 year, I will pay, now as a customer, I will pay $35,000 for the next 12 months, and I will pay them in advance. So the vendor, instead of receiving in the perpetual mode $100,000, now in a subscription model, he will be receiving only $35,000. So this is regarding cash flow. Let's discuss now the revenue recognition, RevRec. So if we sold the $100,000 license on July 1st, a perpetual license, and completed installing it that day, then the RevRec is $100,000. In a perpetual license, it's considered an infrastructure, just like a PC, and therefore I can recognize it in full immediately after installation. So if, for example, as a company, my expenses are $90,000, then my profit for that year, profit as EBITDA, will be 100,000 minus 90,000, meaning I made $10,000. Not bad. If the same software was sold as a subscription license for $35,000 on July 1st, in this case, we can only recognize revenue for the month the software was available for the user. I sold it on July 1st, so I can recognize it for the second half of the year, 6 months divided by 12 times the $35,000 license cost, meaning I can only recognize $17,500. So going back, instead of having EBITDA profit of $10,000, now I'm ending up with 17.5 revenue minus the $90,000 cost. I end up with a loss of $72,500. So the next thing, and to end this session, what I'd like to do is actually go over an example where we can see that for the first 2 years, a company has been selling a perpetual license, and then at the end of the 2 years, converted and migrated to selling a subscription license. Now, this case is a totally synthetic case. What we see here for the first 2 years, that each month we obtained a new customer paying perpetual license of $100,000, and in the following year, each customer is paying a maintenance fee of 18%, which is $18,000. So again, cash flow wise, first year, we see each month $100,000, therefore the line is straight on $100,000. We can see that on a monthly basis, the line is straight on $100,000. In the second year, the sum grows to $118,000 just because we have the $18,000 maintenance fee from year one. And then at the end of the second year, we see this huge drop in cash because we don't have anymore the continuously monthly feed of $100,000. This time we have only subscription income of $35,000. Again, they are paying a year in advance, so we see it every month. In addition to 35 year 3, we also have the $18,000 from the first year's perpetual maintenance fee, and another $18,000 from each of the customers from the second year. So third year we see the $35,000 plus the $18,000 plus the $18,000. And again, you can see here a huge drop in cash flow, something that we need to overcome. Now, obviously, as years progress, our situation becomes better, and after several years, we'll catch up and be in a better position compared to where we started. The main purpose here is actually that you can visually see the huge drop, and just make sure that you have made the right preparation to provide alternative cash flows.